All right. Hello, everyone. Welcome to our webinar on long-term care featuring Natalie Murch. My name is Eric Danielson. I'm the Communications and Client Services Administrator for AFP. We will be recording this webinar and recording any future webinars as well. So we're shooting for about 20 to 30 minutes, might run longer than that. But we will have a Q&A session afterwards. We will stop recording this during the Q&A session, and we'll have this video posted online within about a week or so. Now, in order to make sure this runs smoothly, we have muted everybody's mics on entry. And if you have any questions during the presentation, just use the chat feature. If you look at the bottom of your screen, you'll see a little chat bubble, or you can press Alt-H to open the chat window, and then just whatever questions you have, you type in there, and we'll either try to address them as we go, or we'll get them at the end of the presentation during the Q&A. That being said, if you also have any future suggestions or suggestions for future webinars, I should say, we encourage you to post those in the chat as well. Or you can shoot me or Terry or an email or call us. But that being said, I will hand things off to Terry and Natalie.
Great, thanks, Eric. Really appreciate that. This is our last webinar for the year. As we had looked at our calendar, we realized that doing this the last week of every month was putting us in the time frame of holiday periods for Thanksgiving and for Christmas and New Year's. So we will look to start the webinars back up in January of 2023. So for our last webinar, we have asked Natalie Murch to provide her insights into long-term care. This is a topic that we—
Here, you gotta push the button up there.
Oh,
Here? I don't think people are muted.
yeah.
I got it.
Okay. We find this is a really important topic for our clients to at least identify whether it is something that they should be considering in their overall picture. Some people have had experiences with this with loved ones, and even though the needs analysis that we run will say they don't need any, many times people will say they want a partial policy. So Natalie has been a person we've gone to because she does a great job of educating people on this topic. There's a lot of need to understand the nuances and the language around it, and it just takes a while to kind of get a grasp of it. So we really appreciate Natalie. She's done a wonderful job with our clients in helping them navigate this area. So Natalie, I'll turn it over to you and we'll kind of get moving.
Okay, great. Everybody's seeing the screen, correct?
Yes, I can see it.
Okay. All right. Well, thank you, Terry and Eric, for having me today. As she mentioned, a lot of what I do is focused on education around this subject, not so much selling, although that is how I make my living. Timing is great because, as you see on the screen, November, which is just next week, is National Long-Term Care Awareness Month. And you'll notice that says long-term care awareness, not long-term care insurance. So you'll see things in the media, even probably some TV advertisements that talk about long-term care issues. And the focus really, in my opinion, is making yourself aware of this issue and having a plan, whether that includes the insurance or not, maybe not. But my goal is really to just bring the issue to the forefront so you can think about it and have a plan. The saying timing is everything really hits home with this subject today as we look at what's going on in the market. So on the right hand side, this may be what you've seen your portfolio doing. Certainly mine has been up and down over the last several months. And the idea of having potentially some insurance in place is to have something that is more steady and guaranteed versus trying to time which investments and what money you might have to use should you find yourselves in a situation where you needed long-term care. So let's talk about what long-term care is before we talk about the insurance. So Webster type definition would be the care you need when you're diagnosed as chronically ill. That's pretty vague, right? So in more layman terms, it's day in, day out help with your basic activities. Activities of daily living, or what we call ADLs, I always tell people, think about the first hour or so of your day, what you did when you got up this morning. If you needed somebody to be there to help you do those activities, and we'll talk more specifically about what help looks like and how we define that, but that's really a long-term care situation. It's also care for people that have a chronic impairment, a cognitive impairment, whether that is actually called Alzheimer's, dementia, or just the general process of aging over time. It's also personal care, supervisory care, but most importantly, it's something that can happen to any of us at any time. When we talk about what would cause somebody to need long-term care, that first bullet point, the upper left, Alzheimer's disease, is kind of what I think a lot of people go to in their mind's eye. You know, we think of grandma in a rocking chair, you know, at the end of life with some dementia, and that's certainly part and parcel of it, but there's a whole host of other things that could cause somebody to need long-term care. And you'll see, you know, some of these things probably would never have crossed your mind. Some of them happen at younger ages, and a lot of them are totally outside of what we can control. So we look at what we know about ourselves and our own medical history and a little bit about our family history, but then there's also the whole realm of things that just can happen. So it's a whole host of things. I do hear from a lot of people, you know, do these policies really pay? So I just saw this statistic not that long ago, got these stats from one of the insurance companies that was studied, and they looked at their longest duration claims for men and women. And this is the top 7 companies. And I thought it was pretty staggering to see how much money has been paid out in just, you know, a few situations. But this is why we talk about maybe having some insurance when you look at what the potential cost of care could be coming from an insurance policy versus maybe our own portfolio. So long-term care services are provided across what we call a spectrum of care. The most basic tends to be bringing people to our homes. If we needed assistance for any of those reasons, you could bring the help to you. And you'll see that in the numbers here, more than half of care is provided in the home. That's a great thing because today's policies pay for that. Older policies maybe didn't. But again, it's not just, in fact, very little of the care, less than 1/4 of it is in the nursing home, where I think people tend to think of long-term care services. In fact, people used to call, when I started doing this in the late 90s, people called long-term care insurance nursing home insurance. Oh, I don't want that nursing home insurance because, of course, I'm never going to a nursing home. None of us think we're doing that. And if we can stay at home and have the care brought to us, or maybe look at an assisted living for a more communal setting, or even look at things like adult daycare. Even hospice is covered by a long-term care situation. So it's that whole spectrum of care where services are provided. Why might we consider the insurance? Well, the it here is not the insurance, the it is long-term care services. Needing long-term care services is something that's likely, it's costly, and it's not covered by everything else. So as we mentioned, you know, timing is important. It's likely to happen because we're getting older. So I know this might be kind of hard to see the wording underneath, but on the left-hand side, these circles represent the population that's over 65. So the gray circle was in 2015. Big blue circle is where we're going in 2050. So an 85% increase in the number of people who will be over 65. The right-hand side is the number of people that are over 85. And again, a 200% increase. So, you know, we're living longer, we're getting older. And when we live longer and get older, typically, you know, we find ourselves in a situation where we might need some assistance. The likely part of the situation, again, I feel like pictures kind of speak to this better than just looking at percentages and statistics. So these 4 little charts represent the odds of different risks. So the first one with 1 little dot is your odds of losing your house to a fire. Obviously not a very high risk, but we all have homeowners insurance or condo insurance or whatever we have. The next one over on the right are the odds of your car being totaled. So 5 in 1,200, again, not huge. We all have auto insurance. Even when our cars are fully paid for, we have liability and auto insurance. The bottom left is the odds of being hospitalized. Obviously, odds are getting greater. We all have health insurance, whether we have private insurance or Medicare. The one with the greatest likelihood, all those dots, 720 out of 1,200, is the odds of needing some long-term care. So again, it's a likely risk, and it's one that we need to have a plan for when that happens. Here's the expensive part. Long-term care is a costly issue. We talked about that spectrum of care, the places you can receive care. The three most common are on the left-hand side there: home care, assisted living, and a skilled care or memory care type facility. The numbers as of 2021 show you what the annual cost of those different settings would be. Roll that forward 20 years, 25 years, 30 years, and you can see that just even 1 year of care can be pretty financially devastating. Understand that most people need care for anywhere from 3 to 5 years. Those are averages. Obviously, when we looked at those claims earlier, there are people that need care for much longer. Personal experience. Yes.
Do you know what the rate of increase is here? Are they using 5%, 6%?
This is based on, I believe, 3%. And historically speaking, that has been where we've seen the cost of care track year over year, you know, even if you go back 20, 25 years. Because, and that's a common question, is this like other inflation? Up until lately, you know, we never really talked too much about inflation recently. Now we do. But this is labor expense. So this is very different than healthcare expense, where we have drug costs and malpractice insurance and hospitals costs and all that. This is labor expense. Now, we do see that it's starting to tick up and track at a higher rate, just like everything else is these days.
Okay, great, thanks.
So let's talk about the fact that it's not covered by anything else. Again, it is paying for a long-term care event. A lot of times people say, well, you know, I have Medicare, so I'm covered. Or when I get to age 65, I'll have Medicare, so it's covered, or that Medicare pays for something. It's important to understand that Medicare is essentially, it is health insurance. And health insurance is designed to pay for things that are acute. Something is broken and we're going to fix it. Or I need an operation, I'm going to have that surgery, and then I'll be on my way. So a curable type condition. It's also skilled care. Think of skilled care as people who have medical training, initials behind their names. Those are the ones providing the care. Most importantly, Medicare requires that you are getting rehabilitative care, meaning I'm better on Wednesday than I was on Monday. Most long-term care is kind of the polar opposite. It's chronic, it's not acute, it's not skilled care, it's personal care, homemaker services, those types of things. And typically it's not rehabilitative. So it's kind of the opposite of health insurance or Medicare. Even if you meet all those criteria, Medicare pays everything for 20 days, which is wonderful. Starting on day 21 through day 100, you're in a copay situation and you're paying the lion's share of whatever that rehab center or facility that you're receiving care in. If the care is custodial, which is what most long-term care is, Medicare doesn't pay. So on average, Medicare pays about 23 days of skilled care in a facility. Beyond that, for home care, other situations, not a lot of money coming from Medicare. So the other Medicaid or the other federal program would be Medicaid. And you'll see that I've capitalized the last 3 letters there. In my world, the easiest way to remember what Medicare is and what it's designed to pay for is people who have depleted their assets and their income. So it is aid, it is welfare. It is not designed, was never intended to be how we pay for long-term care for the masses as people age. So there are very specific criteria. You can see them on the screen here, but basically when your money and your savings and everything that you've worked for is gone, then there will be a program that steps in to pay, but it's not necessarily going to be the kind of care you want or where you want to be, i.e. in your home, etc. So there are also some very specific guidelines to try to keep that money in the pot that it was intended for. The other one I commonly hear about is, well, I have disability insurance, so I don't need long-term care. Disability insurance is designed to pay for the bills that you already have before you have the long-term care situation, your mortgage, your utility, the money you're putting away for retirement, other insurance policies. And it typically only covers a portion of those bills. So we're talking about adding on a new expense that is not covered by those disability insurance and still has a shortfall. And also disability income typically stops at age 65, which is when we get to the point where we're more likely to need the care anyway. So if it's not covered by anything else, how do people pay for it? Most people end up immediately tapping into income, savings, retirement, all the things that, you know, we have set aside to enjoy later in life or to pay those other bills. So without a plan in place, it's basically our money. If we use insurance, it's somebody else's money, or what's most common is a combination of the two. See a lot of people doing the whole co-insurance concept, and we'll talk about that a little bit more. When could you collect from a policy? Well, a long-term care policy has two triggers, either a cognitive issue or needing help with those two of those 6 activities that we talked about. And what defines it as long-term care is that we're going to need help for at least 90 days. So I'm going to talk a little bit about the whole cognitive side because I was on a call not too long ago, and this was kind of eye-opening to me. Again, when we talk about cognitive issues, we think about dementia and Alzheimer's and all of that. And people think about memory issues, but a lot of cognition is not just necessarily memory. It's the orientation and reasoning and issues pertaining to safety. So for example, think about dressing. It's not just, can I get dressed? It's, can I pick out appropriate clothing for the season, for the temperature? Has the clothing been washed in the last week? You know, do I have things on inside out, right side out? With eating, not just, am I able to eat? Did I remember to eat? Am I eating the right foods? Is the food spoiled? Am I taking it with medications? With walking and transferring, you know, can I go outside? Yes. Can I transfer safely? But do I remember where I'm going or how to get home? Do I remember the safety devices that I need? So that's all part of the whole cognition discussion. And then when we talk about assistance, we're not just talking about, same thing with bathing. It's not just somebody physically giving me a bath or helping me with the shower. It's somebody helping me to get in and out, somebody laying out the clothes, somebody making sure that the water temperature is set properly. So it could be hands-on assistance or standby assistance, which is also part of just verbal cues and safety and supervisory. So when we talk about insurance, we're basically talking about a pot of money. A lot of people hear me use that analogy. And there are really 4 building blocks to determine what a policy looks like, how much benefit it has, and what it costs. So these are the decision points. And this is where the customization of a policy comes into place. Terry mentioned that sometimes, you know, the needs analysis might show that you can self-fund a portion of the risk, maybe all of the risk, but sometimes people want to have just a little bit of coverage to help out or to give you that flux of the timing. So really 4 decision points determine what your policy looks like and what your premium would be. The first one is what I call your allowance. You have a certain amount per month to pay towards care. And then you've got a lifetime maximum. I call that your checking account. So you've got a pot of money or a checking account, bank account, whatever you want to call it, that pays for your care. Again, you decide how much you want in that account. You're going to have a deductible, which is called the elimination period. So a small portion that you pay before the policy pays, just like every other insurance. And then we're going to add some interest potentially to that bank account. So there are 4 ways to set up the policy, lots of different ways to mix and match within that to find something that works for your situation and your budget. The policy covers all those types of care that we talked about, where care is covered, where care occurs, hospice care, memory care, skilled care. With home care, I kind of pointed out the most common is people providing homemaker chore services and personal care. So certainly if you need a nurse or a therapist to come to your house, that would be covered, but the majority of care is not that. It's unskilled personal type care. Policies also include something called care coordination, and this is available whether you have the tiniest of benefit or the maximum in all categories of benefit. And this is kind of what I call the concierge. This is somebody that's there to help certify that you're eligible to receive your benefits when the time comes. They put together the plan of care for you. What are we going to do? How many days a week? How many hours a day? They provide essentially like an Angie's List to say, hey, in your area, here are 3 home care agencies that do a wonderful job. Here's maybe 1 or 2 where we might not recommend those. It's not a preferred provider list or in-network, out-of-network. It's just somebody to make recommendations. They also manage and monitor the care to make sure the caregiver is connecting with the person that needs the care and everything's going smoothly. And they also help connect you to free services so that you can save the money in your policy for other things and find the Meals on Wheels or the other programs that are available. So that's part of every policy. And I will tell you, having been through this with multiple family members, this is a wonderful thing to have at your disposal. There are two types of policies available today when you look at long-term care. There's what we call pure protection policies, which are comparable to term life insurance or your home, your auto coverage or disability policy, where you're paying for one thing and one thing only. Gives you money to pay for long-term care services, but that's it. And then there, kind of the newer kid on the block is what we call asset-based policy, which is more like having a whole life policy instead of a term policy. So it guarantees that it will pay a benefit. Typically comes with a little bit higher price tag because it is guaranteeing a return versus, say, a term policy, which might be less expensive, but only pays if you die during the 20-year term. So both good options. A couple of things about the asset base that I want to point out, just because it is new, is that the whole concept was basically a way to reposition money and self-insure instead of using dollar for dollar, use an insurance contract. So basically what we're doing is transferring money from here to here. A lot of it is paper transaction versus us writing a check, but it's also a guaranteed policy. So premiums are guaranteed, everything in the policy is guaranteed. And sometimes people call it a live, quit, or die contract. The thinking is, if I live long enough, I'm likely to need care, it will pay for that. If I want to quit, it has a cash out option. You'll get some or all of your money back. And if I die without ever needing care, then it pays a benefit to my beneficiary. So it's got a little bit more robust benefit. Everything is, again, locked and guaranteed. When you're at a younger age, sometimes the cost difference between the traditional or pure policy and the asset-based is little to none. As you get older, the divide between these two types of contracts does grow a bit. This is a question I get all the time. What does it cost? How much does it cost to get a long-term care policy? My response is, it's like buying a car. You could buy a Ford, you could buy a Cadillac, you could buy a Mercedes or a Bentley. It depends on how much benefit you want. I will say that in today's world, it's very common for people to co-insure a part of the risk, and having folks like Terry to help figure out for your particular plan how much coverage we need really helps me customize a policy that gives you the right amount of benefit for you. But I will show you just some ballpark numbers here. A lot of times what we do is look at a good, better, and best approach. So maybe we want a little bit of coverage, a policy that would give us $3,000 a month of benefit with that 3% inflation, $100,000. For a couple, that might cost us $3,000 a year. If I'm willing to spend a little more, maybe I have a policy that gives me a monthly allowance that starts at $4,500 and a bank account that's getting a little closer to $200,000. And then if I'm willing to spend a little more, maybe my bank account is over $200,000, my monthly allowance is more like $6,000. That 3% inflation means that now 30 years down the road, I've got a lot more money in my bank account and I've got a lot more money available each month to pay for care. So again, just ballpark numbers when people say, hey, how much does it cost? Depends. It depends on what you want and depends on what premium works for your budget. There's lots of different ways to fund a long-term care policy. Sometimes it's just out of income. A lot of times, more commonly, what we're looking at is using things like cash value insurance or annuities where there is growth and maybe we want to reposition some money. That last bullet point is the one I'm most excited about. We now can use qualified money, all that money that's been set aside pre-tax to structure a policy that kind of defers that tax and spreads it out over a period of time instead of paying it all at once. A lot of times it's the required minimum distribution that you need to take. So if we've got to take that money out anyway, is there something productive that we can do with that after we pay the tax on it and have that money available? So lots of different ways. We talk about business, and I'm going to show you in a minute. If you're a self-employed person or own a business, there's a big advantage with long-term care premiums and the tax savings there. This is something I talk about frequently with people. What about the premium and the pricing? Policies that are available today have very different assumptions than policies that were written 10, 15, 20, 25 years ago. Without getting too technical, there are really three components to pricing. The lapse is how many people every year just cancel or go away or shop and go to a different company. The interest rate that we can earn on the money that is paid in premium, and the morbidity, how many people make a claim. All three of those assumptions in today's policies have been radically changed from what used to be included in a policy. Another change is that rates are gender distinct. 20 years ago, if you bought a policy and you were a couple at 55 years old, husband and wife paid the same amount of premium. Today, women pay markedly more because we know that women's claims last longer and are more expensive. So a lot of things that have changed to make the policies much more stable. Actually, 3 or 4 companies have dropped their premiums in the last several months as interest rates have gone up, because the insurance company can now earn more money on the premium coming in. And so they can afford to charge less for that growth that they're including, that interest component in the policy. So policies actually do cost less than they did before. So how do we pay for the policies? With the hybrid contracts or the asset-based contracts, again, the premiums are 100% guaranteed. They will never change over the life of the policy. And there are more payment options. Those hybrid contracts or the asset-based contracts used to be only available with a single premium. What's happened over time as people start to buy policies at younger ages, you know, a couple in their 50s might say, I love the idea of this asset-based contract, but, you know, I don't have $100,000 to move over and fund a policy, but I could pay it over 10 years or 15 years, or pay it each year as I go along like I would a traditional policy. So lots more options in those hybrid contracts. In the traditional policies, most of them have been just pay each year as you go along like your other insurance, but there are ways now to also shorten that payment window. I pay it 10 times and I'm done. Maybe I pay it 1 time and I'm done. Or I could look at an option to have it paid up when I'm 65. So a lot of times that ties into, hey, that's when my premium or my income is going to go to a more fixed status. So I would like to not have this premium to worry about anymore. So those payment options can coincide there. I mentioned the tax deductibility. If you own a business or you're self-employed, you are able to deduct some or all of the premiums based on a chart that I'll show you here in a minute. The key is that normally if I take a tax deduction on something, when the benefit comes out down the road, I have to pay tax on that. With long-term care, you get the best of both worlds. You get the deduction, but you don't have to pay tax on the benefit. If you're talking about doing this in a business setting, you can also do this on a selective basis. Business owner could insure themselves, their spouse, a couple of key employees, but it doesn't have to be offered to the entire company. If you're an individual and you have a high deductible health insurance plan and you've set aside money pre-tax in a health savings account, you can use those dollars to pay long-term care premiums. And again, the benefits are still tax-free. A common question I get is, how does that work? Why would the government do that? Well, it's much better for people to have individual insurance policies and the government give up a little bit of tax income revenue than to have people spend all their money down and then have to go to that Medicaid situation. This is the chart. I just got the numbers for next year. But if you're a self-employed person or you're using a health savings account, this is the amount of premium that you can deduct. And it's based on the age you are in the year you pay premium. So let's say you bought a policy when you were 59 years old. You could deduct for yourself and a spouse, each of you, $1,790 of that premium. For the year that you're 59 and the year that you're 60, that would be the case. Once you're 61, now you could deduct up to $4,700. And I will tell you, for two 61-year-olds, you wouldn't need $4,700 times 2 because policies don't cost that much. But this is the amount that you could deduct if you were a business owner, if you had a health savings account, and take advantage of that tax deduction. And that's a federal and a state deduction. So a couple things to remember. When is the right time to look at this? Insurability is huge. I cannot tell you how many times people are ready to look at some long-term care insurance, and whatever has happened with health conditions or medication changes, I'm not able to find the coverage. So sooner is better than later because we typically don't get healthier as we get older. So think about the insurability and your ability to lock in your age and your health before something changes. Same with affordability. Premiums are based on your age at the time you purchase, and they're locked in at that rate. So younger is always going to be less expensive. And certainly the peace of mind. That's what we're talking about here. Whether you have just a little bit of coverage or a more robust policy, having something to provide that concierge type service and some extra money so that you're not immediately having to scramble and liquidate or tap into your own funds, just to have that peace of mind, which is really what insurance is. So we talked before about planning. This is have a plan in place, whether that includes insurance or not. The goal of planning is to not necessarily pay for every penny for the cost of care out of a policy, but to have a plan in place that helps to manage and monitor that situation and turn something that's an unmanageable situation into a more manageable situation. Okay, what questions came through? Any?
Well, while maybe Eric is looking at that, Natalie, the idea that you can use funds in a 401k plan, does that also include, I would assume, 457 plans or 403b plans?
Yes, IRAs, any qualified funds.
Okay.
And it's kind of a unique situation. Right now, there is one company that really has that process down to a science, but I look for more companies to kind of copy that as we go forward. It works perfectly with inherited IRAs because it's done over a 10-year window. So it fits right in line with the Secure Act and the fact that, you know, that money now has to be taken out over 10 years versus the lifetime. So it's a great fit for that too.
Oh, that's a great idea. So the money would have to come out of the plan and then it could go towards that, or what are the mechanics of that?
So basically it's done, it's kind of what we call the set it and forget it. So we roll whatever money we're taking out of the IRA into another qualified IRA. And then over a 10-year period, each year, a chunk of that comes out and that fully funds the long-term care contract. So that money is coming out again over a 10-year window. You're taking, you know, a small amount of money out at a time. That money can be used for the required minimum distribution in that year. And then internally it's funding a long-term care contract.
Okay, so it's not a tax-free transfer. It is money coming out, you pay tax on it, and then you pay for your premium.
The transfer is tax-free because it's done from, you know, one vehicle to another, but
Yes.
then every year over 10 years, there is a part that comes out that's paid tax. Yes.
Okay.
So there's no way to avoid the tax on the qualified money. It's just a way to spread it out over time and to, you know, basically have it be put to good use.
Yeah. Okay. All right. Well, I just thought I'd ask. You just never know what the government wants to give us.
Exactly.
We'll take it. Eric, were there any questions?
Yeah, I was going to say, it looks like there's no questions in the chat.
Okay.
So at this time, we'll go ahead and stop the recording.
Okay.